The Biden administration just made it easier and more attractive for solar and clean energy stocks. And I got 5 of them that I think are worth taking a look at. No, you haven't missed the boat on this bounce. And I think that they're going to continue to move up. And I'm going to give you some reasons as to why. But let me fill you in on what exactly is happening here. So Joe Biden declared a 24-month tariff exemption for solar panel products from Cambodia, Malaysia, Thailand, Vietnam, and China is part of that. This is according to Reuters. The move comes as the Commerce Department investigation into solar industry in Southeast Asia has added more hurdles to import equipment. And so this is very interesting because we saw solar energy and renewable energy stocks actually pop off on this news, but it's not all good news, especially not for US based solar companies. There's some domestic producers, including a California company that filed a complaint with Commerce about unfair competition from Chinese imports, and said that Biden's actions would help China's state subsidize solar companies at the expense of U.S. manufacturers, which I thought was very interesting. So there's definitely that headwind that could be coming for solar companies in general. However, even with this tariff being lifted or exempt for 24 months, whatever, there's still this clear issue with non-renewable energy going up in price, right? And obviously, we're not there yet to have a full transition into renewable energy. We're all aware of that. However, a lot of these stocks have come down to really reasonable levels, and I think that they're super, super cheap and they're worth taking a look at. So let's go ahead and take a look at some of these because the growth stories on all of them are actually quite incredible. The first one that I'm going to be talking to you guys about is First Solar. You may have heard of this one. If it's not new to you, cool. But just to kind of give you a snapshot of what's going on here, this company is profitable. First Solar has done extremely well. The growth story here is also has a pretty bright outlook too. Their current year revenue is around $2.48 billion is what's to be expected there. 2023 is supposed to come in at $3.26 billion. And I would imagine, given the way that we've seen some of their earnings come in, that this stock is still going to do much, much better than that, especially given the fact that we're going to see, in my opinion, some pretty extreme demand destruction in non-renewable energy, and a lot more people are going to flock towards solar panels to power their homes. And so looking at this, let's take a look at the chart on First Solar. So I give you some thoughts as to where I think this is going there. And this obviously has taken an absolute beating. It's trading at $31 per share as of this recording. This was all the way up at $44 back in June, and it's down around 19% on the year. Obviously had a pretty decent down move from $37 all the way down to 28, trading at 31.36 as of this recording. But it looks pretty good from a risk reward standpoint. With all that revenue coming in, the stock's only priced with a market cap of $4 billion. I just got done telling you that in 2023, they're expected to bring in $3.26 billion in revenue, and the valuation here is at $4 billion. That is insane. To me, that is stupid cheap. And you look at where this is trading right now at $31, and you say to yourself, okay, this looks like there's a potential rollover in the making here, and we'll have to see how that plays out. But in the long run, I think that this is going to be something that actually is a pretty cheap stock, even from 12 months from now. If we get some sort of relief more than just tariffs on this, then I think, and I'm talking about supply chains, if we get enough supply to actually support the demand for renewable energy, First Solar, I think, is definitely going to have to be on that list for something to invest in. Next is going to be ChargePoint. Now, ChargePoint obviously isn't a solar company, but with the price of gas and the price of oil continuing to go up, you have to believe that demand for EVs is going to continue to skyrocket. And there isn't nearly enough infrastructure to actually support that yet. However, ChargePoint in their last earnings explained that they're seeing significant growth, and demand is absolutely ridiculous right now. The supply chain, of course, is going to continue to be a problem, but they're navigating through that. And I think ChargePoint certainly stands to benefit from this. They provide charging stations commercially as well as residentially. And I think that, you look at, of course, the Tesla charging stations, and their infrastructure is fantastic. There's no argument there, but it's still not enough to support the EV demand and the amount of EVs that we're going to see over the next 5 to 10 years. ChargePoint certainly comes into play here, and I think that this has got to be one to own moving forward. This has a market cap of around $5 billion. They're expected to bring in around $741 million by 2024. And so that's going to be a significant bump from their 2022 expectations of just $130 million. That is a ridiculous increase over the next 24 months. So to me, ChargePoint is going to be the buy here. You could look at Blink, of course. Either one of those I'm cool with, but ChargePoint was the one that I went with. Next, it's going to be Plug Power. Now, Plug Power is very interesting as well. This is a more of a hydrogen play. Obviously talking about Biden and lifting tariffs as far as solar power is concerned, is certainly there. But this stock's down 33%. And we look at some of the other non-renewable energy stocks, and they're up 100% plus. This one's down 33, and I think that we're starting to see this come into a really nice valuation. They provide hydrogen fuel cell turnkey solutions for mobility, material handling, and stationary power markets in North America and internationally. Plug Power's fuel cell solutions address clean, renewable energy needs. This also makes it very attractive if you're looking to have energy and not have to pay a ridiculous fee for it as we continue to see energy prices go up. We're looking at natural gas potentially around $20 by the end of the year, and that is not out of the realm of possibility. But what's crazy about Plug Power is that quarter one revenue of $140.8 million is 95% year-over-year growth. A GAAP earnings per share of a loss of 27 cents, which obviously will be very sensitive to a rising rate environment, and we all know that. However, the growth here is just absolutely insane. And looking at the chart here, you can see that there's a clear resistance at around $19 a share. It's trading at $16.92 as of this recording. But I think that if we can see a move up over that $19 mark, this could really start to get interesting. Obviously, a rollover down and maybe a test of $15 a share as that recent support is likely, but I would really love to see this make a break over that resistance. Either way, if you have a longer term outlook on this, Plug Power is definitely going to be one to own. Next is Sunrun, and this is going to be one that will probably continue to be talked about in the near future. This is one that they've done incredibly well on their earnings as well. Growth is ridiculous. They are also operating for a loss, much like Plug Power, but not necessarily the same amount. Their losses are a little bit smaller than what we're seeing from Plug, even though I still like Plug Power as well. They estimated earnings per share for their next upcoming quarter is around a dime. This is 10 cents. Really nothing big there. $489.8 million is also the expected revenue. For all of 2022, it's around $2 billion in revenue. 2.15 is the expected here for Sunrun as well for 2023. So that growth there isn't necessarily as significant as something like a Plug Power, but it's still pretty darn good. And given the fact that we're going to likely see this shift in demand from non-renewable to renewable energy sources, Sunrun has got to be also on your radar, in my opinion. By the way, if you're enjoying this video so far, make sure you hit that thumbs up and subscribe to this channel if you've not done so already. If you haven't hit that notification bell, make sure you do that too, because I go live at 3:45 p.m. Eastern time from Monday through Thursday to cover earnings as well as anything else that's going on the market too. So if you guys want to be a part of those live streams, it's a ton of fun. I certainly would encourage you to join those as well. My next stock is going to be none other than Enphase, and this by far in this list is one of my favorite stocks in this space. Unbelievable profitability. 82 cents per share is their next expected quarter. For the year of 2022, they're expected to come in at $3.47. 2023, $4.27 for the year. That equates to $2.08 billion for 2022 and $2.73. That's another $730 million they're expecting for 2023 in their fiscal year. That is significant growth. I mean, insane. So while all these stocks I think are worth owning and worth at least taking a look at, Enphase by far is going to be my favorite one. Definitely let me know what you guys think about this in the comments, because I see a lot of chatter about Enphase all the time, but there's just a lot to like. There's a lot of reasons to like this stock. And let's take a look at the chart right now, because this could also be on the verge of a breakout. You can see that this is looking like a pretty decent cup and handle on the daily chart. The RSI is obviously getting a bit hot, sitting at 60 percentile. But a break over the 221, 219 area could certainly bring in some FOMO buyers. So even in the short term, I like Enphase, but especially the long term, this stock's not going anywhere. If you guys want to take a look at this one, certainly do your own due diligence. But this, in my opinion, is my favorite one. If it does end up rolling over, which it looks like it may be a possibility, then we could see this potentially come back down to around 180, which is where the 250-day moving averages intersect. But I have to believe with that kind of growth that we're seeing out of Enphase, uh, that's it's going to look awfully cheap at $200 a share right now, even if you have to go through some volatility owning it up here. So let me know what you guys think about this in the comments below. And again, make sure you're hitting that thumbs up and subscribe to this channel if you want to see more content such as this. And I'll see you in the next one.